Ashwini Agarwal, co-founder and partner of Ashmore Investment Management, joins us. Oh, sorry, Ashwini Agarwal, good morning and thank you very much for joining us. Force of habit. Ashwini, thank you very much for joining us. Well, first up, how are you looking at the global scenario? I mean, we saw this ferocious FII amount, coming in. How will it be here on? What is your best guess?
So, Latha, there's a structural element to it. And of course, last month's flows were also impacted significantly by the huge MSCI rebalance, the biggest favorable rebalance that we've seen in the history of India. So I think to expect that what's happened in November will continue in December and January might be a little bit of a stretch. But on a structural basis, our call on a global basis appears to be that investors will take money out of the US and put it into assets outside the US, principally driven by impending weakness of the US dollar. Our whole macro argument there is that over the last 10 years, the rally in the US dollar and its role as a reserve currency has made a significant difference to the way global assets have been invested, and US has received a disproportionate share of global flows. And this should reverse, looking at how things are positioned at this point.
Ashwini, good morning. Great to have you on the show. I'm going to quickly rewind back to a conversation we were having with the principal economic advisor in this earlier part of the show. My clear takeaway was that he gave ample hints that the government is completely focused on supply side recovery. He spoke a lot about, reviving capex. I don't know how it's going to be done, but the question is, if you are a believer in this, how do you position for it? Because we know that this is the part of the market which hasn't run up.
So very interesting question, Surabhi. We have been a little circumspect about the government's ability to spend a lot of money. If they do, that will be a welcome news. And of course, we will need to do the repositioning as required. You're starting to see some traction in cement, for example, as a play on that. But if you look at engineering, you look at construction, those stocks have kind of not done much till now. But if what you say is true, and if the government ends up spending a lot of money, then domestic capex related stories will see much bigger traction, and that would include everything from cement to steel. Steel is doing well anyway, and it would include construction, and probably a late rally in real estate, which typically happens towards the fag end of a domestic cycle. So I think you're right. I think the market also doesn't expect it, which is why these stocks haven't done well. But if the narrative changes, then obviously, these are the sectors that should get rewarded.
Okay, well, I just want to point out that Escort's numbers also flashed for you on the screen, and the numbers looked very good for the month of November. Total sales up 33% year on year, and the management commentary is also very optimistic. They say that healthy water reservoir levels and a good harvest is something that will continue to support the tractor industry. Ashwini, good morning. I wanted your thoughts here, because this whole rural pocket has really blossomed over the last many months and continues to do well, whether it's tractors, auto financiers, even the consumption stocks. Is this a story that will continue to play out, or do you think that the best is already in the price?
So I think there have been a lot of enabling factors helping rural India. First and foremost, the impact of COVID in rural India has been far lower than what we've seen in urban India. Crops have been very good. Output has been very good for 2 years now. Prices have been remunerative. And the fact is that the government, whatever little money has been spent, that has been spent more towards revival of rural demand than focused on the urban areas. So if you put all these things together, then there is a reason to believe that the rural demand will continue to remain strong for a while. Now, if there is something which is kind of a one-off here in terms of families buying two-wheelers, or families consuming products that allow them to sort of battle COVID in a sense, where they don't want to use local transport, and the menfolk are being encouraged to buy motorcycles. And if there's a one-off element in those specific pockets, we might see a slowdown as we go along. But overall, I think rural will continue to do quite well.
Okay. Well, Ashwini, I don't want to put sectors and themes in your mouth. You tell us, an incremental $1,000 or an incremental 100 rupees, what will you play?
So, Latha, we discussed this a little while ago as well. So, what I would do is focus a lot on the financials. Okay, financials are still relatively inexpensive compared to where they've been historically. I think if you make a case that there is going to be more fiscal stimulus and that the economy should continue to do well, then I think fiscal is the financial is the area where you will see a significant amount of upside. I would also say that both pharma and IT have relatively underperformed over the last month, given obviously the robustness of the flows and people chasing stocks that were moving. But I think the fundamental earnings outlooks for these sectors is quite strong. So given the relative underperformance, I would be partial towards these two as well.
Okay. Ashwini, are you a believer in the housing recovery? I mean, data from across the country is telling us that residential sales have picked up. But so how do you that correlate with the way stocks have already moved and, you know, balance sheet issues? And basically, will you be investing in property stocks?
So, this is a very difficult one. We've really looked hard into this space. And, unfortunately, while there is aggregate demand improvement in housing and people are buying new homes, cost of ownership has gone down significantly. The problem is that when you look at stocks, you're dealing with specific issues, specific projects, specific balance sheets. And we haven't been able to lay our hands on any idea so far. This is one of those very weird situations where we are positive on the macro outlook, but bottom up, we haven't been able to figure out, where to invest.
There are some nascent signs of a pickup in private capex, Ashwini, but we haven't seen that reflected in the stocks. I mean, L&T still continues to be one of the big underperformers for the year, although it has recovered a bit in the last 1 month. Is this a space to bet on, capital goods, for the next 1 year?
Sonia, no. I feel that I think the government will spend less than what is being promised. I also think that the private sector is very cautious at this point. So to expect a broad-based recovery in capex, private or public, would not be a theme I would like to play on at this point. I realize and I see that many of these stocks have significantly underperformed, but I just don't see the room for growth that would justify the current prices. So I would stay away from here.
I buy your argument. Already, where their backlog of expenditure, it's largely subsidies. And therefore, even if they spent what is left in the budget, which is a goodish bit, it would still be largely transfers and not really adding to, capex. As well, it's usually state expenditure, which has a much better traction with GDP, and states are completely broke. So, I mean, I find it a little difficult to believe that government-related capex will take over. But, private sector-related investment has done very well in the second quarter. Its, contraction is down to -7 from, -30 or thereabouts. So somewhere something is clicking. Is there, therefore, what would you bet on in that space? I mean, is it...
So, Latha, the percentages actually reflect a bottoming out. So what's happened is that, this is my opinion, what's happened is that people who had started the projects are completing those projects, but they're not starting any new projects. So, on a year-on-year basis or on a quarter-on-quarter basis, you might see some positive directional data, but does this mean that the private sector is aggressively setting up new capacity? I think the answer is no. I think the production-linked incentive-based investments, I think some investment in pharma and chemical space, which is seeing a reasonable amount of traction from overseas demand, those might be the few areas where, you can expect some investment. And if you want to play a specific theme, or a specific stock which plays to these particular themes, that might work. But overall, I think private sector continues to be quite cautious. I think, one of the very interesting things on a more macro basis is that the amount of focus on ROCE and ROE that we continue to see with companies. So, unlike the past where growth at any cost was the narrative, now I think a lot of companies are saying that, look, are we going to deliver a decent ROCE that investors expect to see on the incremental investment that we make? And that kind of narrows down your avenues for investment. That's the other issue because the narrative has changed.
Okay, now I just want a final question on exports. That's fired for the GDP, and that's fired even from the, look at Bajaj Auto numbers. Their, export numbers have done better than their domestic numbers. But can we bank on that going forward? Because there is this surge in virus cases, more lockdowns we hear in Europe and US. Any of the export plays, any thoughts on what one should pick?
So, it's very interesting. Okay, so what does India export? Okay, so we export a whole bunch of gems and jewelry. That part is a big mystery to me. I don't know where it goes and how it goes and so on.
And there are no stocks anyway.
So, and then you have textiles, which are actually doing quite well. And it's a bit of a necessity. It's a bit of, staying at home, wanting people to sort of buy more curtains and bed sheets and upholstery and so on. So that's doing quite well, actually. And if you look at the rest of the export that happens from India, whether it's IT services, whether it's pharmaceuticals, a lot of it is actually necessity. So I don't see a big problem there. And there is a China plus one narrative, which is real and it's playing out. Coming to Bajaj Auto, and that's reflective of what's happening on a more general basis, we call it the South-South trade, emerging market to emerging market trade. And if you look at where Bajaj Auto motorcycles go, it's a lot of emerging markets. And, they make very, very good motorcycles relative to what you pay for them and how long-lasting they tend to be. So I think, this whole thing about exploring markets outside the West in the emerging markets or developing markets or less developed countries is going to be an increasing focus for a lot of companies. And I think the disruptions there are far fewer. So my take is I'm reasonably optimistic about exports. I think the risk there is currency, where bulk of your trade tends to be US dollar denominated, where end markets are not US dollar denominated. You might be able to extract price increases, but in a lot of markets, especially US and Europe, it's going to be much harder for Indian companies to extract price increases in face of a declining currency. And that might be the challenge that we might face 12 months from now.
Ashwini, I don't know if Mr. Rakesh Sharma could hear you or not. I think he was already mic'd up because he's actually, coincidentally, our next guest. So, yes, I'm sure the compliments that you paid to the kind of motorcycles they make and their export markets, if Rakesh could hear that, that would have been good to listen to the management, for the management of Bajaj Auto as well. Ashwini, thank you very much. By the way, apart from sales, Bajaj Auto is also looking to rejig its holding in the KTM joint venture that they have. They've just made, a disclosure to the exchanges. So we have to talk about the sales, what they're doing with KTM. Lots of that discussion coming up with Rakesh after the break.